So good morning everybody and welcome to the first macro financial review of 2016. I'd like to introduce you to our new Deputy Governor, Sharon Donnery, who has direct responsibility for financial stability of the bank in her area. Then she's joined by Mark Cassidy, who's the Head of Financial Stability, Gabriel Fagan, our Chief Economist, and Ed Sibley, Director of Credit Institutions. So as usual, we'll be taking questions from you at the end of the presentation, and we'll have a roving mic if you could just do that so that the sound is picked up for the video. And with that, I'll hand over to Sharon.
Okay, thanks Jill. Good morning everyone. The mission of the central bank is to safeguard stability and protect consumers. And in this context, the monitoring of macro-financial developments and risks is an important task for the bank. The macro-financial review offers an overview of the current state of the macro-financial environment in Ireland. It aims to assist our key stakeholders, the public, financial market participants and national and international authorities in better evaluating financial risks. It also aims to promote informed dialogue on the financial system's strengths and weaknesses. And finally, it contributes to the formulation of evidence-based policies to mitigate risks and safeguard stability. Output grew strongly in Ireland in 2015, and the latest MFR finds that growth is projected to remain strong in both 2016 and 2017. Nevertheless, risks to the economic outlook are weighted to the downside and stem mostly from uncertainty in the external environment. At European level, markets remain volatile. This relates to a number of factors, including geopolitical tensions and the outcome of the forthcoming referendum on the UK's membership of the European Union. Low growth and the large stock of non-performing loans continue to create risks for the stability of the European banking sector. The low inflation environment is also creating challenges for firms with particular business models in the European insurance and pension sectors. A UK vote to leave the European Union would have both short-term and long-term effects on Ireland. In the short term, volatility of the euro-sterling exchange rate could provide some challenges for indigenous firms who export to the UK. Over longer time horizons, a negative impact on Irish exports to the UK could also be expected. The overall effects on the profitability and business models of Irish-based financial institutions could be material and will vary across firms and sectors. The effect will depend on their exposure to UK markets and the nature of the new relationship agreed between the United Kingdom and the European Union. In addition to monitoring financial markets and potential risks as part of the Eurosystem, the bank has been engaging with financial sector firms to assess their preparedness for the risks associated with Brexit. Turning to the domestic macroeconomic environment, while economic conditions are improving, debt remains high in both the household and corporate sectors. This leaves households and firms vulnerable to adverse movements in income or interest rates. Our forward-looking vulnerability analysis suggests that among existing mortgage holders, first-time buyers, younger borrowers and those on standard variable rates remain most vulnerable to shocks. Similarly, the government debt ratio remains high, leaving the public finances vulnerable to economic and financial shocks. Therefore, maintaining fiscal discipline is necessary to keep the public finances on a sustainable path. Against the backdrop of economic recovery, domestic banks returned to profitability in 2014, but profit levels in 2015 remain weak and varied across individual banks. Progress continues in the workout of impaired loans and the disposal of non-performing assets, and the overall non-performing loan rate has fallen to 15.4%. However, impaired assets and related provisions remain elevated. The domestic non-life insurance sector continues to face a difficult operating environment, with all of the high-impact firms reporting underwriting losses in 2015, primarily due to the current challenges in the Irish motor market. In the non-bank financial intermediary sector, risks centre on the potential for intermediaries in Ireland and abroad to play a destabilising role in international financial markets at times of market stress. The central bank is today publishing details of a call for evidence, which will inform the first annual review of the impact and effectiveness of the mortgage market rules. The analysis in today's MFR will prove useful for those wishing to make submissions, and we look forward to receiving data-based and other analytical submissions which will help inform our assessment. In this context, the MFR notes a marked slowing in house price inflation and a decline in house price inflation expectations since the introduction of the measures. Although the number of residential property transactions continued to increase during 2015, activity in the market remains weak. The report also highlights the scarcity of residential units for sale and rent. The mortgage market rules were enacted in February 2015 to enhance the resilience of households and banks to financial shocks. We acknowledge that our measures impact on individuals' ability to access credit and purchase houses. However, these loan-to-value and loan-to-income ratio limits are designed to protect the system as a whole and to limit the risk of a house price credit cycle emerging once again. And in this context, the bank must take a medium to long-term view. The measures were introduced as a permanent and structural feature of the Irish mortgage market, and the evidence threshold to justify adjustments to these rules is significant. While the housing shortage is widely acknowledged, housing shortfall issues must primarily be addressed by other targeted policies. Those who wish to make submissions on evidence on the impact of the measures can visit our website centralbank.ie, and the call for evidence will remain open from the 15th of June to the 10th of August. I will now hand over to Mark Cassidy, Head of Financial Stability, to give some further insights into key elements of the macro financial review.
Good morning, everybody. So let me take just 5 minutes to elaborate a little on some of the issues from the review as highlighted there by the Deputy Governor. It is, as you know, a very detailed report. You will understand I don't have time to do more than touch on some of the issues. We are available at the end to take any of your questions. Also, you may not see in full detail the charts behind me, but hopefully I can clearly explain the main points regardless. So we find that external risks have increased since the publication of our last review, which was last December. One element of this is evident on the left-hand side of this chart, which compares IMF growth forecasts for the major regions from those of last October 2015 with the latest forecasts, which were published in April 2016. The chart shows evidence of a weaker global macroeconomic environment with downward revisions to growth forecasts for both this year and next, including for key trading partners of Ireland, including the UK, the Euro area, and in particular the US, which is the red bars. In addition, though not on the chart, is the fact that financial markets, particularly in Europe, have been particularly volatile during the first half of 2016, which reflects a number of things, including uncertainty about global economic prospects and the future path of monetary policy in the United States, rising political uncertainty also, including in relation to Brexit, and concerns about the health of the European banking system. And although there has been some recovery in European financial stress indicators more recently, the risk remains high of a further increase of financial turmoil, which could be triggered, for example, by emerging market stress, low commodity prices, or renewed concerns about European banks or other financial institutions. Domestically, the macroeconomic environment continues to improve and faster than previously expected. So the chart on the right-hand side shows Irish GDP growth, including forecasts up to and including 2017. So the blue line running through that chart shows the strong pickup in GDP growth that has been recorded since 2012. GDP growth was as high as 7.8% last year. Strong growth of close to around 5% this year and a further 4% in 2017 is expected, and both domestic demand and exports are expected to contribute. It's not shown on the chart, but another very favourable development in recent years has been the steady decline in the unemployment rate, which has now fallen below 8%, having peaked at around 15% in 2012. While in the report, we also describe how household incomes have also been increasing. Our overriding message, though, is that despite the favourable domestic developments, Ireland remains exposed to the heightened external risks, both from an economic and a financial stability perspective, given first the openness of the economy, but also the vulnerabilities that remain from the crisis, including high public and private sector indebtedness and fragilities in the banking system. The chart on the left-hand side behind me shows overall private sector indebtedness, that is the red bars, which notwithstanding recent declines, still stands at around 240% of GDP, which is very high by historical but also by international standards. Incidentally, a large amount of the corporate debt, or the NFC debt, which is the light blue line in that chart, relates to debt of international rather than domestic-based firms, and we have a box in the review that highlights the importance of that breakdown. Our high level of household indebtedness, which is usually measured relative to household disposable income, is shown on the chart on the right-hand side. It's shown in comparison to other countries and currently standing at 160% of disposable income, which leaves us the fourth highest rate in the EU. And the risk is that high private or indeed public sector indebtedness leaves the economy vulnerable to any interest rate or economic shock in the future. And we have a box in the report that shows the vulnerability of different cohorts of mortgage borrowers to any potential shocks. So as per usual, we provide in-depth assessment in the review of both residential and commercial property market developments. In the housing market, as you can see on the left-hand side, there has been very clear and welcome moderation in the rate of house price increases in Dublin over the past 18 months. Prices outside Dublin have continued to increase quite steadily, but expectations for future price increases have moderated in both Dublin and nationwide. And we also have a box in the report looking at developments in price expectations. Rents, we know, have been growing quite strongly at around 10% per annum over recent years. We know that overall activity in the market remains quite weak, while despite the signs of rising output, the scarcity of housing units for sale or rent is the prominent feature of the market. And the recent decline in the second-hand units, both for sale and for rent, can be seen on the right-hand side of that chart, which is also in the report. We've been drawing attention for a number of years now to signs of rising imbalance in the commercial real estate market. So on the left-hand side of that chart is evidence that prices and rents are continuing to increase across all segments of the markets, including offices, industrial and retail, most particularly in the Dublin office market, but with evidence also of supply shortages in certain segments. We know, and looking at the right-hand side of the chart, we know that a greater level of international investment and foreign non-bank funding has been evident in recent years, which has boosted demand at a time when bank lending to the sector has been weak. And the different sources of investment expenditure and the foreign investment expenditure are evident on the right-hand side, which again is replicated in the report. On the supply side, incidentally, there is also evidence of a relatively large pipeline of stock for the Dublin office market likely to come on stream in the coming years, which maybe implies some risk of a potential oversupply of development at some future point, particularly if there is a deterioration in international investment demand or external financing conditions. But it is worth noting that the risk to financial stability from this source is mitigated by the fact that the banks have reduced significantly both their exposures to this sector, but also the impairment rate on commercial real estate loans in recent years. So let me finish in relation to the banking sector. So we show on the left-hand side of this chart that non-performing loans continue to decline across all sectors, including commercial real estate, corporate and mortgages, although they remain high. Profitability has been improving over recent years, but it remains quite weak. It varies at individual bank level, and the recorded improvement in profitability last year was largely driven by write-backs of impairments. There has been some gradual improvement in net interest margins over recent years, as you can see on the right-hand side with the blue bars, but they remain quite low, and they've been driven more by falling funding costs or interest expenses, which is not a sustainable source of growing profits given how low these currently are. And interest income, which is the red line, has been falling modestly in recent years. So profitability and sustainability of banks over the medium term remains an important issue for both financial stability and lending to the real economy. So let me hand back to the Deputy Governor, who will provide some more details on our review of the mortgage market regulations.
Thanks, Mark. So the report, which I mentioned earlier, which will be published in November, is intended to bring together an in-depth analysis on the early performance of the measures against their stated objectives, and also to consider the potential side effects of the measures. We intend to draw on a number of different projects internally within the bank in terms of the analysis that we will undertake as part of the review, looking at household resilience and borrower types, banking resilience and bank lending practices, including examining how the allowances, so the thresholds above the loan-to-value, loan-to-income ratios, which are an important feature of the measures, are operating. We will look also at house price and credit dynamics, and we will look at various potential side effects, including in relation to the rental market, housing supply, and also unsecured lending. So this slide gives an overview of some of these different elements. As I said earlier, an important part of the review is the call for evidence, which we are opening tomorrow, in terms of understanding the views of others at the operation of the measures, and we look forward to receiving those submissions over the coming weeks. And we're happy to take your questions.
Just a question on Brexit, on the short-term volatility that might follow a vote to leave. Might the central bank have to take some form of action to ensure financial stability? And I mean, what might that be if there's a intense market reaction to a vote to leave?
Well, I said in my opening remarks that as part of the Eurosystem, but also domestically in terms of our own regulated firms here in Ireland and their preparations, we've been very focused in recent weeks on preparing for all contingencies, and work is in hand in relation to that, regardless of what those contingencies might be.
Well, what do you see as the most specific in the short term?
I think short-term disruption in financial market volatility will be our most significant concern in the short term.
Wait for the microphone, please. Right. Thanks very much.
You say you're engaging with firms about the preparedness if there's a vote to leave. How do you prepare for something like that? What kind of things can you elaborate on that a little bit?
So I suppose in terms of the firms, there are various potential impacts, both short-term and medium-term, depending on their particular business models, what types of firms they are, their interrelationships with the UK and the UK market. There's obviously considerable uncertainty in the medium to long term if the outcome is a vote to leave, given that we don't know yet what the UK's new relationship with the European Union would be. So the focus really in terms of contingency planning is around immediate measures, the potential for short-term disruption in euro-sterling exchange rates, for example, that I mentioned in my opening remarks. And obviously the engagement with the firms is very focused on exactly what their exposures are and what volatility and uncertainty they might be exposed to over those days and weeks in the early days of the outcome of the vote.
Next question, Brady, from the Sunday Times.
Yeah, hi. I wanted to ask about the interest rate environment. I suppose, firstly, does the bank have a view on how long these extraordinarily low interest rate cycle is likely to continue? And secondly, I mean, there's a lot of controversy, especially in Germany and other Eurozone countries, about the ability of banks to withstand this very low interest rate environment. And you've touched on that this morning, but we don't really hear the Irish banks, I suppose, bleating or as much comment on what this means for Irish banks, how long they can sustain this very low interest rate environment.
Okay, I'll take the European aspect, and then maybe Ed wants to talk about the impact on the Irish banks. It's been very clearly stated by the ECB in terms of its monetary policy that it will continue with the policy stance that it has until there is evidence of a sustained adjustment in the path of inflation towards its objective. So basically, the existing set of measures, for example, the QE package that we have, extends until February, I believe, next year into 2017. And it's been indicated that should further measures be necessary, that will be taken. So basically, as the policy of the ECB is essentially conditioned on the evolution of the economy, and in particular, the extent to which inflation is moving and evolving in line with the objective of the ECB. So, I mean, there are a range of estimates out there. If you look at market prices, you can see that markets are expecting this low interest rate environment to prevail for a considerable period of time, but that's just one set of estimates. Do you want to deal with the bank aspects?
Sure. So I think the situation in Ireland is more mixed than circumstances perhaps in Germany, where there is a drag on net interest margin associated with a low interest environment. But there's also been some benefits for the Irish banks in terms of reduced funding costs, and given the vulnerabilities in the loan books that they face, it's given time to and room to address some of those vulnerabilities and address the non-performing loans. So it's a more mixed picture, I think, in Ireland than perhaps in other European countries.
Can I ask
John
you
Walsh.
sorry,
Time's on the line.
just in terms of the increased political awareness of interest rates and soundings coming from politicians that if you perhaps don't do something, then they might force your hand to increased regulation. What are your thoughts on that?
Well, I think the Governor has been clear in his recent comments that it is not our view that the best outcome in terms of the market, particularly in terms of competition, is for the bank to be given a mandate in relation to the regulation of interest rates. Having said that, the Governor has also made clear that should we be given such a mandate, then it's obviously incumbent on us to look at that statutory aspect of our role.
Colin Kelby, Irish Independent.
Talk about the fact that you're engaging with firms around the Brexit issue to gauge how prepared they are. Are they prepared at this stage? Do you have any concerns that firms are struggling to make contingency planning for this?
So I wouldn't say we've been concerned about firms struggling. I mean, I think there's been, as I said earlier, a range of issues. Some of those are focused more on the short term and more on the medium to long term. In terms of the medium to long term, given the uncertainty about the potential for an eventual relationship and negotiation, firms really have had to prepare or consider a range of scenarios, and there remains some uncertainty about how exactly any of those would play out should a Brexit happen. I would say in relation to short-term contingency planning for any events that might happen immediately after a referendum, we'd be satisfied that all contingencies have been prepared for.
And Geraldine Reiner.
Would you say just among those firms that you are dealing with, is there widespread concern out there that the UK may leave?
I think everybody is aware of the significant risks should the UK choose to leave. It's particular potential for negative consequences for the Irish economy and so on. So I think firms are well aware of that. The firms that we supervise would have a very wide range of business lines and business models, so the potential for impact on them varies significantly across sector, depending on what those particular firms' line of business is, what exactly their business model is, what their own relationship with the UK is, what type of business they do in the UK. So it's very varied, but I would say that for firms that have significant interactions with the UK, there has been positive engagement in terms of potential effects.
Okay, Vincent Bowman from the Financial Times.
Thanks. Just a question on the household debt to GDP. To gross household disposable income. It's 150% of gross household disposable income. What is is that a comfortable level for you guys, or do you want it to come down, or how does it compare historically, and where would you like it to be?
There's no number where we'd like it to be. I think the European comparison that I showed there and that's in the chart shows that it remains high by international standards. It's about the joint third highest in the EU, and I think that suggests that it's higher than we would like it to be. I think the favourable development is the ongoing decline in this rate over recent years, so it's definitely on a favourable path. I think the steps that have been taken in the area of mortgage arrears, but also the natural repayment of debt since the height of the crisis is all helping this. So it's on a favourable path, but it's higher than we would be comfortable. The problem is the higher the level of indebtedness, if an economic shock occurs, even if the previous path has been favourable, the more households are vulnerable in terms of higher interest rates or higher employment. That's why we'd like to see it come down further.
Right, and just to follow on that, is that debt mostly mortgage debt?
Yes.
Okay. Any other questions? Niall Brady here from the Sunday Times.
Yeah, just returning to the low interest rate environment, I think the bank has previously raised concerns or potential concerns about what this might mean for I suppose, the retail market, and I suppose the flight out of deposits maybe, or well, there's no evidence of that, but that people may be tempted to maybe go into higher risk investments in an attempt to get some sort of return on their money. Is that still a concern or a real concern, or maybe you could expand on that?
Yeah, I mean, I think it's not a specific Irish question. This is a broader global issue. that there is some concern in the, if you like, people concerned with monitoring financial stability, that the low interest rate environment is inducing agents to go out, if you like, on the risk-return frontier and take on more high-risk investments. That is definitely the case. And what is their big concern, if you like, one of the major risks at a global level to financial stability is of an abrupt reversal of that pattern, so a flight to quality which would lead to major disruptions in asset markets. So that has been identified by the ECB and by other international organizations as one of the key global financial stability risks at the moment.
Okay, Dara Doyle from Bloomberg.
Hi, sorry, back to Brexit. Sharon, I think you said that the central bank is very focused on preparing for Brexit contingencies. We know the ECB has talked about liquidity will be available for banks in the event of Brexit and a shock. Can you give us any other details of what other kind of things can you put in place for June 24th or the week after if there is a vote to exit?
Well, as part of the Euro system, obviously we've been involved in those discussions in relation to ECB and other preparations. I think, as I mentioned, the main concern around the short term is the impact, for example, on exchange rates and other financial markets elements. And so the focus around contingency planning has very much been around that.
What can you do to ameliorate? I mean, presumably sterling would drop 10-15% almost instantly. What can you do to...
Well, I'm not sure that we can do anything to ameliorate what might happen in the markets. I mean, we're not going to be able to do something to prevent volatility and so on, but we can make sure that both the firms and ourselves are prepared in relation to, for example, the provision of liquidity and so on. So provision of liquidity is really the key here. There's not really much else you can do. Well, I would say there are also issues around communications and so on over those days, and firms being prepared internally themselves in terms of queries and so on that they may get and engagement with customers and so on. But
So I think that's right. I mean, we have a really important role in terms of our engagement with supervised firms to make sure that they themselves are prepared. They understand the risks. They understand what the potential impacts of that volatility or other potential short-term impacts are, and whether it's funding or communication or other impacts that might have on their businesses. That they themselves are prepared. And in the run-up and the immediate aftermath of a vote, we will be in very close contact with the firms to make sure that they're managing the issue and we're aware of the issues that are emerging.
So is it the case that the central bank is making sure that the banks have proper contingency plans rather than the central bank having a single contingency plan ready to go on June 24th? Do you understand the difference?
I mean, in terms of the banks themselves,
yeah.
We've been very actively engaged with them to make sure that they themselves are prepared for the immediate downside risk of a vote to leave. We ourselves are working hard on making sure that we have appropriate contingency plans in place, that we are prepared for that downside risk event.
okay, John Walsh, Times Online.
How confident are you that the government can stay within the fiscal rules, given the increased spending pressure and I suppose the minority government's decreased ability to enforce the fiscal discipline?
Well, quite frankly, we don't think staying within the rules is an option, in the sense that you have a choice whether you're going to stay in or not. We are required by the rules that we have in place to abide by those rules, first of all. Secondly, I would say, look, if you look back at the debate during the election, one of the things that was really striking was the very fact that across the political spectrum, there was a widespread acceptance of the rules. Now, that's a very different situation in Ireland than you will find in other EU countries where the rules are controversial. So really, basically all of the parties were supporting and saying we must adhere by this friend. So I think given that broad consensus within the political environment in Ireland, I would be not too concerned that we would violate the rules.
And sorry, just to follow up in terms of the, is there any room for interpretation of how the capital spending is applied under the fiscal rules? It's becoming a big issue in terms of the bottlenecks in the economy and the increased need for capital spending. Can that be done within the existing guidelines?
I just wanted just to reiterate the purpose of today's event is about the macro-financial review. So I think maybe if you want to elaborate on it, probably just a small bit further, but if we could just keep the questions to the content of the report itself.
Well, I think these are matters for Eurostat and the Commission in terms of interpretation. It's not for us to make decisions like that.
Okay, Umber Kennedy, The Irish Times.
Just in relation to Brexit again, how steep a fall in sterling have you provisioned for?
I'm not going to comment on that.
I wonder if there are any further questions? Okay, if there are no further questions, thank you very much, and we look forward to seeing you in the second half of the year for the second macro financial review. Thank you.